Hey guys, welcome back to another week where we talk about all things real estate related. Questions about the Ottawa market, about investing, you can always put it in the comments below and we'll make sure we make a video about it in the future. But a lot of people that are interested in real estate are also interested in other types of investment. That's why at our brokerage a couple weeks ago we had a special guest to come talk about investments aside from real estate and how they correlate. So today I have a special guest with me here, Mathew Hall. He's from Exponent. He's a financial planner and a portfolio manager. So thanks again for coming by, Mathew.
Thanks for having me.
So Matt, first things first, if someone's looking at getting investing right now, but they're worried about what's going on in the stock market, what's going on in the real estate market, what would you suggest that someone invest in today?
Again, very person specific, as all investing is. In terms of the volatility we're seeing in both the stock market and the housing market, the key thing to do when times get rough is to pick assets that are negatively correlated as much as possible. So the presentation I did for you a couple of weeks ago demonstrated slight negative correlations between large financial markets, so the US stock market, the Canadian stock market, and the European stock market, as related to the Teranet National Bank House Price Index seasonally adjusted. What essentially that's saying is there is a diversification benefit from having stocks as well as real estate. So the short answer into what you should invest in is both, if at all possible. Most people own their homes, which gives them a real estate play locally. But it makes sort of intuitive sense that large companies in the US would have a reasonably low correlation with, say, your principal residence or even rental real estate in Ottawa. I.e., it doesn't really matter to, say, Apple, what's happening in Ottawa in terms of the real estate market. Found it pretty interesting that even the Canadian market is somewhat negatively correlated, not as strong as the US, and neither are close to -1, but they are negative enough to add a diversification benefit to anybody's total wealth.
So if you were worried about one of them crashing, ultimately if you own both, it's kind of a safeguard against that?
In a financial panic, probably all assets correlate positively to one, meaning that everything will move in the same direction for a short period of time. The question would be, once you're through that volatility, what's going to move and in what direction? And that's where you would like to have negative correlations. So typically, housing markets are derived from employment, interest rates. Employment is extremely low. Interest rates are moving up and up and up. That's having a bit of a negative drag on the housing market because one is sort of canceling out the other. Stock markets are forward-looking, so it's basically everyone's consensus view about what's going to happen. So what you're seeing is a lot of volatility in the market this year in particular, largely because stocks don't do too well if interest rates go up. The movement is not the same as real estate for a variety of reasons, but similar in so much that large companies also borrow to invest in their businesses, and if those borrowing rates goes up, those projects become less profitable and have a little bit of a depressive effect on the stock price.
And so what would be the advantages and disadvantages in either investing in real estate or in the stock market?
There's a couple of interesting ones in Canada. Probably first and foremost, the dividends paid from Canadian companies, so companies listed on the Toronto Stock Exchange, domiciled in Canada, have a fairly substantive tax advantage versus other types of income, passive income, that you can earn in Canada. Ran it through a quick tax calculator, sort of comparing $150,000 in income and then $24,000 in either rent or $24,000 in Canadian dividend income. And the difference is about 7%, solely because of the dividend tax credit, the dividend gross up and the tax credit that's applied. Further to that as well, their financial assets can be held in tax deferred and tax sheltered accounts, for example, RSPs and TFSAs, where direct real estate ownership cannot be held. You can hold debt related to real estate, but not the real estate directly. The main differences between real estate investing and financial investing typically have to do with the income that's earned. So the capital gains on both are preferentially tax treated. In fact, the capital gain on your principal residence is even better than, say, a stock asset, in so much that no one in Canada pays tax on their principal residence through the principal residence exemption. If it's an investment property, it's taxed as a capital gain, just like a capital gain on a stock would be. I.e., you leave out half the gain for tax purposes and you're taxed on the remaining half at your marginal tax rate. So in that sense, they're relatively the same. The difference is in the treatment of income. So a dividend from a Canadian company is grossed up and a tax credit is applied to it. Income from rents is taxed as ordinary income, no tax credit, no gross up. The net effect on a tax return, and this would of course depend on your tax situation. I'm not an accountant, but rough calculation on 150,000 in income, and then 24,000 in either rent or dividend income would be about a 7%, I think 6.7% to be exact, in favor of stock on the income. So there can be some advantages on the income side. As an extension to that, because you can hold financial assets in tax-deferred or tax-exempt accounts where you can't hold direct ownership of real estate, for example, RSPs and TFSAs, there the passive income is delayed indefinitely, right? Good news is in terms of capital gain as well, where you don't pay tax on capital gains in an RSP or a TFSA, well, until you have to take them out, or for a TFSA indefinitely. With real estate, you're not going to pay a capital gain on it until you sell it, which could be years and years in the future. So it does provide a substantive amount of deferral.
And what would be some negative things to look for in either type of investing?
Probably the single biggest issue I come across when I have these types of conversations would be volatility, right? The stock market appears to be much more of a ride. This is true, it is more volatile than real estate as an asset class. It's also valued more frequently. Stocks trade sort of every second of every day and arguably overnight now. Real estate, on the other hand, you really only know the price of a transaction when it happens, and those can be decades apart. So the advantage, I would say, one versus the other, is real estate is going to feel like a lot less of a bumpy ride, right? And how you feel about your investment is a very important part of investing.
I know real estate isn't your area of expertise, but after talking to you a bit, I saw how much you see the world differently and all the kind of factors you're coming into play. So what is it that you would see to look out for in the Ottawa real estate market?
Again, I'm definitely not an expert here, but again, from my outsider perspective, I think what I see is there's probably going to be a movement back to city centers. So as a result of the pandemic, people wanted a little bit more space. They were working from home. And correct me if I'm wrong here, but my understanding is the price appreciation in some of the outlying areas around Ottawa was significantly higher than the city, which kind of reverses a long-term trend where houses within the city proper tend to increase more in value. Mm-hmm. My thought there is, there are some people who are going to be called back to work, even in a limited capacity. If you've gone too far out, you're probably not going to want to drive, 2.5 hours combined a day, even if it's 3 days a week. The other concern I have, and this is because I do tend to serve a little bit of an older clientele, is your access to healthcare, depending on how far out you've gone. Classic example is you're in your 70s, maybe the health starts to slide a little bit. Would be nice to be closer to, say, a hospital. If it's a longer drive, you might need to make a change to where you live. And I say that having some older clients who have done that. They've moved out from outlying areas into the city solely for the proximity to healthcare. I think it also depends a great deal on how much time you now intend to spend in the property. A lot of people, for example, are going to start going back down south for the winter. When you're not at your house, you kind of have to worry about what happens to it. So perhaps you might want to, live in an area that has, more of a community, neighbors around who can look in on it, that sort of thing, right? So I think I see, long and the short of it is, I think I see a movement back towards city centers. Even tech companies in the States, been in the news, calling a large percentage of their workforce back to work. Even if it's only to start in a hybrid model, sort of 3 days a week. I still think you're going to see, sort of a shift to more of the traditional demand within the city proper, especially as it relates to sort of going to the office, access to transit, that sort of thing. Just my sort of uneducated opinion.
No, I think I would agree with you 100%. It was impossible to find a home in the outskirts of Ottawa for the last couple of years because of the amount of demand. And I'm already seeing it where people are having to go back to the office, for sure. So I actually could ask you questions all day because I appreciate it. But if anyone's looking to get into investing, how would they go about getting a hold of you?
Just reach out for a chat. My contact information is on the screen right now. Always happy to have a phone call, see if I can help. If I can, I'll be honest with you. If I can, I'd love to.
Awesome. Thanks a lot for coming.
My pleasure, man.